There is no guarantee that any strategy will be successful or achieve investment objectives. All real estate investments have the potential to lose value during the life of the investments. The income stream and depreciation schedule for any investment property may affect the property owner's income bracket and/or tax status. An unfavorable tax ruling may cancel deferral of capital gains and result in immediate tax liabilities. All financed real estate investments have potential for foreclosure. Because 1031 exchanges are commonly offered through private placement offerings and are illiquid securities, there is no secondary market for these investments. Like any investment in real estate, if a property unexpectedly loses tenants or sustains substantial damage, there is potential for suspension of cash flow distributions. Costs associated with the transaction may impact investors' returns and may outweigh the tax benefits. Thank you.
Hello, everyone. David Moore with Equity Vantage. It's April 24, 2025, and I've got a couple of distinguished guests here today, and we're going to talk all things DST from the sponsorship position, the broker-dealer position, broker position, and then the 1031 exchange facilitation position. So, Mr. Smith, would you like to introduce our distinguished guest today?
We have with us Steve Mark, who's head of capital markets, and is basically the number 2 guy at Emerson Equity. Emerson Equity, our broker-dealer, is by volume the largest entity in the DST space, and Steve is responsible for onboarding almost all DST product. So there are very few human beings in my consideration that know much more about DST and what should be there and what shouldn't be there. So take it away, Steve.
Oh, great to be here today. I love talking about DSTs. I love informing the general public about DSTs, the benefits, things they need to keep in mind when choosing the right DST and the right property and the right DST. And I love working with reps like Bob at Emerson. Emerson has over 200 reps, and Bob is one of the very top producers at our firm.
So I was so excited to get to Steve that I didn't even do a proper introduction of Bob Smith of Peregrine Private Capital. So those that are familiar with our channels know that we have Bob on a lot, and we do a lot of transactions and video work together. But Bob is sort of one of the top guys that has been in the brokerage context in the DST space, and I've been blessed to work with Bob since we're talking probably the mid-'90s, mid-late '90s anyway. And I think we were first introduced by Dale Glasser, who did a lot of tax work. He still does he doesn't do much tax work anymore. I think he's retired, but or not officially retired, but he's got a foot out the door. But I think he introduced us, and we spent some time at the racetrack actually too together, and we have a lot of fun doing different things, but we've done a lot of transactions through the years, and I think that originally we're sort of dealing with institutional tenancy and common stuff, and before the DSTs actually hit the scene, and we were going to tell some stories during the next hour or two, and we will be breaking this video up into different segments, so you don't have to sit here, and it's not going to be a 3-hour Joe Rogan deal, but we'll have some fun, and hopefully we'll give you some nuggets of knowledge and get everybody on a different level as far as knowledge of DSTs, Delaware Statutory Trust, what they are. And I think one of the things, we live in a world of acronyms, and a lot of people are going to say, what do you mean? Why a Delaware Statutory Trust? What is that? And why do I want it? And so I don't know if one of you guys wants to sort of just start off by explaining what that is and sort of how it came to be.
Well, as an attorney, Mr. Mark, why don't you take that and run with it? Okay.
Well, I'm admitted to practice law, but I don't practice law. I focus on, at our firm, working a lot with our DST sponsors, Delaware Statutory Trusts. And what we try and do is we try and bring great sponsors into our broker-dealer channel that will sponsor the DST and allow for fractional interest by individuals doing 1031 exchanges into the Delaware Statutory Trust.
So we look at this space, really what happened, we've got the sponsor who is actually acquiring the asset or group of assets, they're packaging it, and then we've got Emerson who would then vet that, and
Yes.
then we've got someone like Bob at Peregrine that's going to sell what you've vetted and put on the platform and made available,
Right.
just in a nutshell. But
Right.
as far as when you're doing the due diligence and sort of picking and choosing which of those offerings the sponsors you're going to handle or put out there, so what are sort of the steps you take to make those decisions?
Well, sometimes at Emerson, we're lucky. We actually serve as the managing broker dealer for over 10 sponsors. And so in that situation, we get to actually work with them on the structuring of the offering. And while it is the sponsor's offering, our input from individuals like Bob and other representatives at Emerson help the sponsor to build in the type of things that investors are looking for ahead of time. Because once the offering is what I like to call completely baked, right, it's ready to launch, and it is what it is in the document. So I think the pre-prep before it comes out of really putting in the offering what reps want to see and what clients of reps want to see, and advising sponsors on what those issues are in any given month is what's really important. I think what really separates Emerson apart from other firms, and what Bob is doing apart from other reps as well. With regards to, I think the question was more on due diligence and what we're looking for. Obviously, what we really want to look for, two main things: the sponsor and what's their experience. And a lot of these are real estate offerings. So what is their experience over the last decade, 2 decades, 3 decades in real estate? And then also look at the actual underlying property itself and what vertical that property is in. There's numerous verticals, right? Sometimes multifamily is the most popular, right? And the property will be a multifamily property. Sometimes it might be self-storage, right? Or it could be triple net lease or senior living. There's all different verticals for the representatives such as Bob and his clients to look at. And we at Emerson have numerous offerings on our platform to show potential investors.
And you guys are sort of we talked a little bit about Bob and his background and where he sort of stands in that hierarchy. Emerson's the gorilla in the broker-dealer world, right? I mean, you guys have been doing it a long time, and the lion's share.
Yeah, we've been doing it a long time. We've been around since 2003 or 2004. We were founded by our CEO, and he owns 100% of the firm. So we can make decisions very quickly on offerings, whether they're offerings we want on our platform or don't want on our platform. We don't have a lot of bureaucracy at our firm, and I think that's why we've grown and added numerous representatives like Bob over the last decade, because there is a lot of flexibility for representatives to see a lot of offerings, which then they can vet and show to their clients.
I'd like to make the observation, because we helped create the DST in conjunction with the Inland Real Estate Group in 1999, 2000. So we are the oldest retailer of DSTs in the nation, so we've been around since Christ was a corporal, and for better for worse, we've been through a number of independent broker-dealers that have gone away. And without exception, Emerson Equity, Dominic Baldini, who is the CEO and owner of Emerson Equity, is the most investor-centric executive president of a BD we have ever dealt with, bar none. And I'm not saying that because we're here now. We've had good experiences with BDs. We've had bad experiences. Emerson Equity and Dominic Baldini and the firm that he has created in conjunction with Steve is simply the most investor-centric BD out there, in our humble opinion. They're fantastic to work with.
So with that said, Bob, you're talking about history, and you talked about when Emerson was started, and you think about, before we started filming today, we talked a little bit about the history and a little bit, Bob, we've been through the good and the bad times together, and I've got a gentleman in the oil and gas world that as I said earlier, he said, I don't want to work with people that are, sorry, no offense, in their early mid-40s, right? Because the problem is, if you haven't seen a bad day, you don't know what can happen. And I don't care. I always jokingly say that I'm always happy to learn. I'm tired of being taught. And I would say that what good people come to me. We like to say we work. You've worked hard for your money. We work hard to keep it yours. What good is a tax-deferred exchange into something if what you buy goes away? And during the last crash, we had a number of institutional tenancy and common companies. We ended up having go into foreclosure, and people don't understand the consequences of a foreclosure in a debt over basis situation with phantom gains. And in those transactions, what was happening is there'd be a reorganization attempt coming in, and they'd be working to get it taken care of. The 11th hour, they'd say, "Nah, we're going to take the property." And for the people that understood, there's something called phantom gain. If you've got debt in over basis, that delta, the debt is treated as a sales price, and you could lose the property foreclosure and actually have to pay tax to deal with it. And we worked with you guys on a number of those zero coupon deals that were available at the time. And the question was pretty easily answered if you understood to ask the question. And I guess the other thing I'd say is we talked a little bit about AI and all this stuff. People don't want to talk anymore. And you got to take advantage of the people, that have been through these things and their knowledge, because you don't know what you don't know.
Right.
AI is not going to help you in a lot of this stuff because it doesn't really have any context. But people need to ask questions early, and I think that vetting process, Emerson's background in vetting those projects, getting people where they want to go, because in a transaction where I'm trying to keep the people's money working forward into something, and if somebody in today's world, Steve, if I said, "Hey, Steve, I'm a new sponsor and I've got product out there that's going to pay 12%," and I got a bunch of investors want to buy it. Hey, let's put it on the platform. You're probably going to have some questions.
We do. Always when working with a first-time sponsor, right, you're going to have a lot of questions. You're going to want to know what their real estate experience is, what I talked about earlier. And what we really want is we want experts in real estate, not financial engineering, but experts in real estate. And we find that they bring us the best properties and they're the most realistic on what those properties can do. But then we do dig down into what they're showing us, and a 12% return would be very, very good. So I would start asking a lot of questions on that. That would be out of the norm in the high range. So I would dig down into those numbers and push back a bit before the offering was to come out to representatives and their clients like Bob.
Yeah.
So that gets done in the due diligence process. And we do get a lot of potential real estate experts who want to come into the space. I probably have calls 4 or 5 a week with potential new sponsors, and a lot of them just don't pan out. Not because their deal's bad or there's something wrong with them. It's just maybe not the right type of property or offering for a DST.
Yeah. So Bob, when people are coming to you these days, how often are they looking for ultimate yield versus wealth preservation? And I know there's a few people that we've worked with in the last couple of years where really they didn't care about the ROI. They just wanted to make sure they had wealth preservation there. But I mean, what kind of conversations are you having with these people when they first get to you in today's market versus, let's say, 2 years ago?
Well, I think everybody's a little more realistic now from a total return standpoint. So their focus is, and rightly should be, on asset preservation. I mean, DSTs by definition are fully stabilized assets, meaning they're built out, they're tenanted, and they're cash flowing. So there is no development risk incumbent in DST. That's generally relegated to the private equity stage, which precedes the DST offering. So people are first and foremost concerned about preservation of principal. Their next concern is trying to maximize cash flow, and which oftentimes eclipses the total return potential of a DST, because a well-chosen DST property, if it's in the right place at the right time with good management, may appreciate just like any other piece of income-producing real estate that you've owned and self-managed in the past. So there's going to be a cash flow component, but there may also be an appreciation component. And so that's something that people need to look at, kind of a hierarchy in terms of wealth preservation, cash flow, and any potential gain that's realized at time of sale, because Section 1031 of the Internal Revenue Code is very specific that at time of property sale, the property sponsor manager does not participate in any gain or loss on sale of the property. So it's people need to be brought up to speed in terms of a total in a total picture, a greater picture of what DST can do.
Yeah, I think it is. It's preservation of capital is very important, right? Critical. We're often thinking about that. Most of the clients that we work with, both Bob and I, they've really created a property worth a significant amount. They've probably maybe doubled, tripled, quadrupled their money over a 30, 40-year period. They need to do a 1031 exchange to preserve usually their stepped-up basis. And we recognize that. And we really want to preserve what we call that nut, what they've created. But we also realize they need some cash flow or want some cash flow in their later years. So we like to see some positive cash flow as well. So they're two very important components, but often the preservation of capital weighs out over the cash flow.
So if we're looking at I think if we look at the difference between an institutional TIC and a DST, I mean, typically an institutional TIC is going to be used sort of in a value add play, but I think it's important for people to understand typically that institutional TIC, they're sort of tying up a property and it's a specific property, and then they're going to fill the bucket with investors, and upon completion of that filling, they're going to then purchase it. But the debt typically is going to be recourse, not always recourse to those investors, but that money, your money is going to be stuck with me, honestly, until the bucket's full, and then it'll move forward.
Right.
Where in the DST space, the sponsor owns the asset and sells, and it could be a single asset, could be multiple assets in any given offering, and then you're able to actually buy your interest at any time. So what I've seen that's sort of neat for people that, we're in the People's Republic of Portland, right? And so the property owners have no property rights or ownership rights anymore. And now they want
have liability.
Yeah, they got
don't
liability.
Have rights.
Exactly.
Okay.
And so there's lots of problems here for them. And so we've got a lot of refugees, the rent control refugees, I call them. But the thing is, these people, you commented, they've built this nut, and a lot of them, that's what they live off of.
Right.
And so if you're sitting in a situation where I think, it's been interesting, Bob, with our journey through the years, a lot of times DSTs were sort of the fallback. Well, if you can't find what you want, this is always available.
David was, when DST was created over 25 years ago, David was nice enough, David and Tom, primarily David, was nice enough to take us around and introduce us to all the principals in the commercial real estate community between here and Seattle to try to communicate to commercial brokers that we're not a competitive product, but a synergistic product. That at some point in time, even though you have this false sense of control over your client isn't going to list a property unless you can show him or her something even easier on the back end, and that's where we come in. We are tarred and feathered, run out on a rail, stoned, okay? Fast forward 25 years.
Tarred and feathered,
yeah.
love that.
No, it's true. It's true.
Tarred.
It's like the commercial real estate community simply wasn't open to that message then. Fast forward 25 years, everyone's older, and the majority of wealth, with the exception of tech, in the United States is held by older people. And everyone ultimately ages out of management, period, exclamation mark. And that's when they come to us from a DST standpoint. And as you mentioned, it used to be backup. Now with the population a quarter of a century older, it is now in many cases primary. It's like, I want to stay in real estate. I like the tax advantage cash flow. I absolutely positively do not want to give a third of my money to the government by way of cap gains taxes, but I just don't want to manage anymore. And oh, by the way, I have to start thinking about estate planning, and the fractional ownership of DST very easily lends itself to estate planning with regard to relegation to heirs or delegation to heirs. So you're right, we've gone from backup to primary in many cases now.
And I'm from Northern California, and we have a lot of reps in California too that are part of the Emerson team. And what we're seeing in California is there's individuals that might have a rental property or a multifamily property, and they might be netting 3 or 4% after taxes and upkeep, et cetera, in actual cash flow a year. Now, while there's no promises and no guarantees, we have numerous offerings that investors can look at that pay an estimated higher cash flow than that, right? And we can't get into specifics on specific offerings here, but it is something for an owner of a property to even think about before they list their property for sale. What is going to be their next investment, what their options are going to be. And it's often that's the best time to call someone like Bob and really understand what your next option might look like. And that might drive your view on whether to sell or not sell your rental property, your multifamily property, your triple net lease property, whatever it is that you might own.
Yeah. That's a very good point, because particularly living on the West Coast, as you mentioned, the People's Republic of Portland, and whether it's Washington, Oregon, which was the first all rent control state in the nation, California, the progressive governments are in the business of putting retail landlords out of business because they think they should better provide housing than the private sector. And so landlords' ability to raise rents on properties, particularly multifamily properties, habitational properties, is getting lower all the time. So as Steve just mentioned, you may have a tremendous amount of equity tied up in a great property that you've had forever and a day, but your cash flow or yield on that property continues to deteriorate relative to inflation because you are prohibited from raising rents because we live on the left coast, okay? And so that's something that can be very compelling about DST. It can potentially unshackle you from the tyranny of that rent control and cash flow suppression.
Yeah, no, that was an excellent way to say it, much more poetic than the way I said it. But
he's a wordsmith.
He is. And then there's another element to that is that you might be selling a single asset. It could be multifamily. It could be a $3 million rental property that you have in Orange County or San Francisco. And now you're able to diversify into multiple DSTs. And they could be in what I talked a little bit about earlier, different verticals. So let's say you're doing a $3 million exchange or even a $2 million exchange. You could get into 3, 4, 5 different DSTs into different verticals: self-storage, senior living, multifamily, triple net lease, industrial triple net lease. So there's a lot of different options to diversify, not only geographically, unfortunately, potentially out of California or Portland into other states, but also.
Did you say unfortunately?
Well, it's a bit unfortunate because I do live in California. I do live in California, and I do enjoy living there. But I will say, the majority of people that are doing 1031s in California are going into DSTs are going into DSTs that are in other states. And it is what's happening.
Steve, we've been doing this for a quarter of a century, and I can say without reservation, there is a mass migration of retail landlords off of the West Coast, whether it's California, Oregon, Washington. In Oregon, it used to be get me out of Portland. Then it was get me out of the Tri-County. Now it's get me off of the West Coast, and they're leaving en masse. No ifs, ands, or buts about it.
Well, you and I know Portland is the worst place in the country with respect to 1031 exchanges. Not only do you have the state clawing back deferred gains if there's a future sale, but the city of Portland wants you to continue to file paperwork with them until you either die or pay taxes.
We have investors who 1031 exchanged 10 years ago, a decade, out of Portland properties to points distant, and they're still getting letters from the city of Portland that they owe Portland taxes, and they haven't owned a bloody property in the Portland metro area for a decade. Yes.
You think maybe they'd figure out they ought to stimulate some economic growth instead of just start digging into people's pockets deeper and deeper and deeper. But yeah, I mean, I just look at it. It's just nuts. But I think your point, both your point. I mean, one, the majority of our business is not in this state, even though we're here. And I grew up in the Northern California too, and you know that. But as far as even if I look at our business here, the majority of our business is elsewhere. But even the business here, 30% of the business that originates here doesn't finish here either. So I mean, it's leaving. And I had a presentation last week I did. Where actually somebody mad because they said, I thought this presentation was going to be on exchanging, and it got into politics. I said, well, what was political about it? I put up a map showing state taxes and where people were going, and I did mention that typically when we look at the states with lower tax rates, typically you have, to your point, greater ownership rights. And the other thing that's impacting, and I just see, so you've got people, I think you've got an aging population that is just tired of dealing with the terrible T's or terrible R, rotten R's, as Mr. Spidell says. But you've also got a situation, especially in California, with insurance. So even if you've got a property, your costs, and as you said, Bob, the rent control stymies your ability. You can't even keep up with inflation with the rent control increases, but that's not even taken into consideration cost of capital or the fact that a lot of these older buildings, so they want affordable housing, but anytime there's a real estate transaction that happens, when was the last time anybody bought a property and didn't put money into it? So the quality of the property is predicated by how much market velocity you have. You kill the velocity, the property values, everything drops. And affordable housing is just, as we all know, a joke, but it's the cost of capital. It's the insurance that's going away.
Yeah.
And if you look at where I'm seeing, I'm curious, Steve, and Bob, we've talked about it a number of times, you start looking at, I made a comment about this market, and it's just been going up ever since the last crash. But if we look at residential housing, somebody might have a 10, 20, 30, 40-year loan on something. We start looking at institutional investments, and now you've got 5-7 year term money, and we've got a number of calls I'm taking right now where somebody says, hey, I bought this building at 3.8%. Now I'm looking to refi it, and it's 7 plus. And they can't afford to do it. So back to your comment, you better think about it sooner rather than later, understand where you're going, what's coming. And I just think people got used to this free money situation. And one of the things that's really nice about going into your space is they're not having to go out and apply for the loan and give their firstborn to get a loan on something, and then they're really frustrated. You've got institutional ownership and relationships there.
Well, the great thing, that several different comments I could make there. One of them is the great thing about a DST is the loan is at the DST level, and it is non-recourse to the DST investor. So that's quite different than probably the loan you have on your rental home or your multifamily or your triple net property that you may own. And that is most likely, I would think, a recourse loan that if something goes bad, you're on the hook. Also, in addition to that, when you go into a DST, and if you're providing your balance sheet for maybe other properties that you're buying, you don't have to put that DST debt on your personal balance sheet. So it might free up financing availability for you elsewhere by getting off of that loan on that property and going into a DST. And then the other point I'll just make is, look, we have clients that come to us and they say, I'll only buy a DST that the property's in a red state. And we have other clients that come to us and say, I'll only buy a DST if the property's in a blue state. And we do have some that will even come to us and say, if I'm selling out of California, I want to buy a DST in California. So it is a bit all over the board. But that's fine, because at Emerson, and Bob has access to all this as well, we have so many different offerings from investors to choose from that we're going to be able to fit what their desires are. You might go to a rep at another firm or an RIA that maybe has 1, 2, maybe 3 DSTs to discuss with you. If I didn't look this week, but I would guess at Emerson on any given week we have 60 to 70, right? DSTs on the platform that we can discuss with you. Obviously, we have some we like better than others, but there's different characteristics for different DSTs to fit the bucket that individual investor is trying to meet.
Right, and not to get too far off topic, but therein lies the failing, if you will, or fallacy of 721 UPREITs, because historically the 721 UPREIT was sold as well. This is an opportunity to diversify because you can take that fractional interest in one property and over a year to convert that into operational units of a diversified trust. Well, the trusts historically are not all that diversified. They often at times are burdened with legacy assets like office, which people have been trying to discard as aggressively as possible, retail, which continues to bleed out to e-commerce. And so given the multiplicity of DST offerings on the Emerson platform, you can diversify better functionally and geographically than you can in an UPREIT, and you do not give up your ability for subsequent 1031 exchanges. And I think that's important.
Yeah, so why don't you guys real quick just explain for the benefit of the audience what a 721 is?
So 721 is when sponsors are forming a REIT, and they are, at the time of sale of the DST, they are upreading the DST property into the REIT, and they are giving REIT operating shares to the investors. Now, some sponsors have mandatory 721 upreading, I'll call it, when they don't give you the option to get your money back and do another 1031 exchange, which every DST that is not a mandatory UPREIT, you could get your investment back when they sell that property. It could be 2 years, 5 years. Every DST has a different horizon, 7 years. There's really not too many over a 10-year horizon. But when that DST sells that property, the investors are returned their capital, and they can do another 1031 exchange. They can go into a DST, or they can go buy a property if they want, and like any other DST. In the 721 mandatory UPREIT, they don't have the option to get their cash back. It goes, their property and their DST interest goes into the UPREIT, and they receive operating shares in the 721 UPREIT.
Could you elaborate, not to go too far down in the weeds, but the principal selling points for 721 UPREITs, which has been the spear point of the big wirehouses into the DST space, has been diversification, and I think we have, we've discounted that, but also liquidity. And can you elaborate on the myth of liquidity in 721 UPREITs, because that's a principal selling point for most of these people?
Yeah, okay. So you might have a situation where, let's say the DST property is sold for $20 million, and it's a mandatory UPREIT into the REIT now. And let's say that REIT is worth $1 billion, right? And let's say they UPREIT 5 DSTs or 10 DSTs a year. So they're uprating $200 million of property into that REIT every year. That REIT likely has what you call a gate that they'll redeem up to 5% of REIT interest in cash each year. So you could get in a situation where numerous DST holders whose property got uprated and they now have operational REIT shares could want to sell their REIT shares, liquidate their REIT shares back to the REIT. The question is, 5% of $1 billion is $50 million. What do you do when there's $200 million that want out? Yeah. So they're going to be in sometimes for a little longer than they may want. So we just don't want investors to think it's automatic liquidity when it upreits, right? Because it's a private REIT.
Yeah, that's what I was just going to say. It's not just a publicly traded REIT that you go buy and sell shares of at will. This is private.
Yeah.
And you don't have full liquidation. And I guess the other comment that you made, Bob, is, and there's companies doing this right now where they'll say, well, gee, why do an exchange? We'll just take your property into this UPREIT. And I said, well, okay, so it's my crappy property. Now it's your crappy property in UPREIT. It's still a crappy property, right? I mean, so it really depends on, if it's a private REIT, what the assets of that REIT are.
That's right. Or your property might be the jewel property. Yeah. And now you're upreated into non-jewels.
Yeah. I'm sorry.
And that's the worst case.
Polish the turd.
A bunch of shit, okay? Yeah. And it unfortunately, I mean, most of the people that we have talked to that are already in 721 UPREITs don't know what it is. They know it is a REIT, a real estate investment trust. And oftentimes they think, well, can my broker just sell this for me? And we have to educate them with regard to no, this is a privately held REIT. It is non-market traded asset. So your only exit strategy is to sell it back to the REIT operator. And as Steve just said, that more often than not is gated in terms of how much can be redeemed annually. And the people in these things don't even know, are not able to distinguish between a publicly traded REIT and a privately held REIT. That's how poor a job most of the wirehouse people do informing these people about what they have. And that is a real disservice to the investor. Not a good thing.
So the thing, Bob, you just sort of hit on a topic I guess I'd like to take a look at just quickly in that, who are you buying this stuff from? What's their background? What's their experience? Do they really understand? A lot of these products just seem to be put out there. For example, as you know, we do self-directed retirement accounts in here. So I deal with a lot of financial advisors that understand financial offerings. But when you start looking at what an IRA or 401k can legally do or not do, they don't have any idea. And I would say you got to look at the product and who that product's being put in front of, and who that, the broker, what's their experience, in that context. And how often are you in a situation where you've been doing this a long time, but you're dealing with somebody that's looking to buy, they're cross-shopping you with someone else, and the other broker really has never sold anything real estate oriented other than a traditional REIT.
Yeah, it's, and I think Steve will validate this for me because he's an investment banker by training, and the degree of sophistication in investment banking, obviously because it's institutional, is significantly higher than what we deal with day in, day out in terms of retail investors. And most retail investors, even if they have significant capital aggregates that they've accumulated over time in real property, are relatively unsophisticated with regard to the financial structuring of real property, because that's all a DST is. It's real property with a securities wrapper around it, and it's an imperfect marriage at best. And if the potential consumer of the product has little sophistication, unfortunately, many wirehouse brokers trying to sell the UPREIT have even less, because real property is fundamentally different than stocks, bonds, mutual funds. By definition, it's illiquid, so it is a very much a niche market, a highly specialized niche inside the securities industry. And to be well served, you have to be very well informed. And unfortunately, if you're simply doing it as a retail broker on an opportunistic basis, you're not going to be well enough informed to do a good job for the investor.
Yeah, and a lot of times, I mean, your advisor at an RIA or your rep at a broker-dealer that's at a wirehouse, they're probably doing a great job managing your public stock portfolio.
Yeah.
And we could do that, but we don't do that. Like Bob doesn't do that, I don't do that. We specialize in DSTs, which are eligible for 1031 exchanges. That's what we do 10 hours a day. Bob probably does it 12 hours a day. But that's what we do. So your advisor at the wirehouse, excellent in picking public stocks, excellent, maybe doesn't have much experience in alternative investments. And a DST is an alternative investment, and it's a very specific type of non-publicly traded alternative investment. So I like to use the example of your advisor at a firm could be like your general practitioner, right? You love your doctor, he's great and helps you out. But if you need open heart surgery, you're going to a specialist. And I like to think that we are the specialists in the DST space.
So, I would agree. I mean, you got to know what you're dealing with inside out and understand it. In my world, it's all about taxation, right? I mean, we're always looking at what they've got. I want to know what they have and where they want to be in 2, 5, or 10 years. I'm not going to look at a transaction as just, hey, give me your name, address, phone number, escrow information. We'll put the deal together. I want to make sure it makes sense and that you're getting where you're going. And there's a lot of times people want to, they just think they got to do this exchange, but they're going to do something that ultimately is putting their life on hold for a period of time. An example would be somebody that's exchanging into a property ultimately they're going to move into. Well, you've got a hold period after acquisition. What's your gain on the disposition? And they say, well, gee, it might be 60 grand. Well, and that'd be very low in a lot of transactions these days. But if it's, let's say it's 60 and they got to live someplace else for a year and that rent's 4 to 5 a month, well, you just ate it up in rent.
Right.
So just pay the tax and go do it.
Right.
But you get going. I think that there's a place for all these products. I think like a 721. If we look at in today's world, you've got a lot of people that are being pitched deals with seller finance, which I think is just such a minefield for people. If you're in an exchange buying on a seller carry, great. But anybody selling and carrying paper today, you better make sure it's your paper, your lawyer's taking care of it, and it's getting enough. I had a deal a couple weeks ago where the down payment was going to be several $100,000 less than the closing costs and the tax liability incurred on that disposition. And they were going to have all this money tied up in that installment sale over time. And then you got to worry about default. You got to worry if it's an end game for you. You got to worry about acceleration provisions if you didn't have that in their prepayment. And I've seen them with blind assumptions where that buyer, the nice buyer has a blind assumption right in there so that, the seller thinks it's this person, but that person has a right to transfer it to somebody else. So I think that there's an application for 721, but I think both of you have done a great job of opening people's eyes to the minefields of it. One, don't just think you're in it, that you've got the right to redeem those shares at any time, because that's how they're sold.
Yes.
And two, it's not going to be just a off-the-shelf trading REIT. It's a private thing, and then that REIT is only as good as the product that is in it.
Right. And yes, 721 might be right for some clients, but what we're trying to say is it's very important to go to a rep like Bob and hear the pros and cons, rather than just talking to your advisor at one of the wirehouses that only has 721 UPREIT products, and that's all they can show you because they don't have anything else on their platform, right?
Yeah.
And it's, in that situation, I would say, hey, get a second opinion. Call Bob, right? And that's what I would tell someone. It's free. Call him.
Yeah.
Pick his brain, right? And then to get back to, you mentioned a couple of points about installment sales and more complicated exchanges. I think it's also important for clients to understand there are some qualified intermediaries that are experts and focus on very complicated transactions, like some of the ones you were mentioning. And then there's some that are just banks and they're just forming an escrow company.
Yeah.
And they're just moving and holding money temporarily, and you're not going to get a lot of advice. So if you definitely have a transaction where there's some of these other issues floating around, you want to have a qualified QI. A qualified QI. I hate using the word QI because some people might not know what it stands for.
Yeah.
But yes.
Well, yeah, we like to say we're a facilitation company, not a QI or intermediary, or it used to be the term straw man. But no, you don't know what you don't know.
But most of the big, it's been our experience over the last quarter century that most of the big qualified intermediaries are just that. All they want to do is do as little work as possible and charge as much from a fee standpoint as possible and have no input from an information standpoint into the exchange. And that's what really makes you guys different, is you've been doing it for 30 bloody years. There isn't anything you don't know about 1031 exchange, and you go out of your way to share that information with your clients. So you add very significant value. I tell everybody, if David or Tom tells you it's this way, that's gospel. Take it to the bank from an exchange standpoint, and very few other qualified intermediaries in the business do that. It's
Thanks,
very,
Bob.
very rare. Okay?
Yeah. Well, I mean, it's a situation where, like I said, it's not a transaction. It's a pathway to the goal that they want to achieve. And at some point, we all get tired of stuff. And I laugh because when we start looking at control and people, one of the big objections that we've had through the years with DSTs is the hold periods, right? I mean, and the lack of control. Well, in today's world, I think more and more people are happy to give up control of stuff. But I laugh because, Steve, you made a comment, well, it could be 2 years, it could be 10 years as far as the time horizon of that given asset or a group of assets. And I would have to say, with my experience through the years in this space, it's like, look, they're either going to sell the asset, call it short cycling it, if they potentially see an issue on the horizon, or if they see an opportunity to yield a better profit. That's what they're going to do. And the same people that complain about the lack of liquidity, when it short cycles, what happens, Mr. Smith?
They don't want to sell the property. That is the supreme irony of DST, because everybody's first question and primary concern is, well, it's easy enough to buy this thing. How the hell do I get out of it? Got to get out of it because I can't control it anymore. But as soon as people get over that hump from driving the bus to sitting in the back of the bus enjoying the scenery, and I've just transitioned from tenants, turnover, toilets, termites, to the mailbox money business, they check out, okay? And they become very comfortable very quickly with that property and that process. And then all of a sudden it's like, well, the property's going to get sold. No, we don't want to sell the property. This is great property. Why are we selling the property? So it's like they're so concerned about how they get out of it. And then when it comes time to get out of it, 9 out of 10 of them don't want to leave because you've gone from the unknown to the known, and they're very, very comfortable with the known.
Yeah.
So yeah.
Definitely. So let's talk. One of the big issues that comes up, and I'd say it's one of the big exchange fallacies, is having to replace debt in an exchange, right? Everybody's been told by their tax people, the legal people, the real estate broker, well, if you had $500,000 in debt on the relinquished, you got to have $500,000 debt in replacement. And as I always explain to people, I said, that's totally untrue. Debt can go away in two ways. One by going down in value, which triggers tax because you went down in value. The other way it's going to go away is by adding cash. But if somebody comes to you, and if you think about the product that you guys put on the platform, what's the typical loan to value that you have? And with that said, Bob, I've been through it a number of times. You're just going to sort of mix and match different assets or different groups of assets to fit somebody's debt to equity.
Yeah, it's easily enough done. What would you say?
I'd say the sweet spot average DST that has debt, and there's some that don't have any debt at all, that are just what we call all cash DSTs, because the clients that don't need debt don't want to go into a debt with property or a property with debt. But that's another discussion we can talk about too, of why you may want to. So I would say it's probably about 40 to 50 to 55% debt is normally what we see. Now, we have some that are very highly levered for what we talked a little bit about earlier, if someone gets in a situation where they need more than 55% debt replacement.
Yes.
But I would say the sweet spot is 40 to 50%. A few 50 to 55, and then even less few in that higher range. But again, if you have a situation like that, you're probably not going to see those offerings at the wirehouse or at a rep or an advisor that only has 2 or 3 or 4 offerings available to them. We have, like I said, 60 to 70 offerings. So when you come in, the first thing Bob's going to ask you is, do you have debt that you need to replace? And that is going to be a big question, because that is going to, if you do, that's going to narrow down the bucket of offerings you can look at. I think at our firm, if you said you had 40 to 50% debt to replace, there'd probably be at least, and it changes every month because when a deal fills up, it's gone. But it's probably 30 to 40 of them have 40 to 50% leverage.
Steve, would you take the opportunity to elaborate on why someone who does not have a debt replacement requirement in 1031 exchange may want to assume some debt?
So, and again, they should always talk to their CPA about this, because it's not our job or role to give tax advice. We're actually not allowed to. But it's my understanding that if someone takes on new debt, they create new cost basis, and that new cost basis can then be depreciated, and depreciation can shelter some of the income you're receiving.
Yeah, so if somebody sells a $500,000 property, they just replace it with another $500,000 property. If it's been totally depreciated, there's no depreciation to take. If they take the $500,000 and go into a 50% LTV like you're talking about, now you got a $500,000. Not all of it would be improvements, but you've got a substantial chunk of new property that you can take depreciation on.
Yep.
So not only do you have the depreciation you can take, which by the way is not elective, people. So it baffles me, guys, how often we'll do a deal and Kara's the one behind the camera today for the first time, but thank you, Kara. But you think about the transactions, people coming in with us on these deals, and what their thought processes are on different things, and not understanding if you just sell something, realize again, go buy something, whatever you're buying, there's going to be an allocation dirt to improvements. If we're looking at your product, and maybe we talk briefly about cost seg. If you want to know more about cost seg, take a look at our YouTube channel, type in Equity Advantage, cost seg, and you're going to see a series there. But cost seg in the most basic sense is you buy a rental house, you got an allocation of dirt and improvements. And if you look at what happens, the ROI, if you jack up the improvements versus decreasing the improvements. The more the improvements are worth, the more depreciation you can take. And by the way, depreciation is not elective. The government's going to treat it as though you took it, even if you didn't in an audit. So it's really important you have good tax people looking at these things. You guys typically use cost seg on the offerings.
Well, it's the sponsor that would do the cost seg.
Well, you don't. Yeah, the sponsor.
And it would come from the sponsor. And again, I caveat it all that you should discuss this maybe even before you make the investment or shortly after you make the investment in a DST with your CPA, because your CPA is the one who's going to do your tax return at the end of the year and is the one that should provide you the detailed advice on this. And then often your CPA would get the cost seg or the info they need from the sponsor or the sponsor's CPA.
And I think it's because the population's aging, and again, everyone ages out of management, so many of the people that we're dealing with now are transitioning out and trying to simplify things from an estate planning standpoint, but they've owned these assets forever and a day, so they've depreciated it down to zero, so they're getting very little, if any, tax sheltering on their income. And we're fond of saying one of the nice things about DST, depending on what you do from a debt standpoint, you can discover new basis or additional basis, which will then likely tax shelter more of your income than what you're currently receiving.
So that leads me, so we were talking about UPREITs and that they're not typical publicly traded REIT. If somebody goes and talks to their financial advisor, hey, I want to diversify into real estate, first thing they're going to do is sell REIT shares. Okay, REIT's a stock. It doesn't give you what we're talking about. So if you're talking about the ownership of real property, if it's leveraged, you're going to have, with improved property, you're going to have the depreciation component we've been talking about. You're also going to have interest deductions there. So real estate, and real estate doesn't have to go up to make you money. You've got somebody's paying down the debt on it during the time you own it too. So there's a whole variety of things. I always say, I'm a real estate guy. I just don't like, I don't gamble. I just don't like my money to go away, right? So I like real estate because at the end of the day, I've got a good buddy that had a good buddy. Unfortunately, he's passed away. But he says, hey, it's not a get rich quick scheme. It's get rich surely but slowly scheme with one golden rule. Don't get yourself in a situation where you got to sell in a recession.
Right.
So if you look at that stuff, and that sort of leads in the time horizon, and the sponsors of these investments are people, I mean, we deal with a number of them that have been in the business for 40, 50 years. They've been through the good and the bad. They can tell you the stories, but people will sometimes, they're concerned when they come to you, say, well, gee, I don't know them. I'm giving up control to them. And I like to say, well, if you're working with one of these sponsors, put it this way, what are the odds they're going to have a problem versus you personally having a problem? And especially when we're talking about time, money, like I said, loans that are coming due on institutional type properties today, those people are concerned with their ability to actually put a new loan in place or potentially sell an asset. Right. And these sponsors, the big ones that have been doing it forever, I mean, they've got stories to tell, and they've been through the good and the bad, and I just look at that issue. But the debt piece is definitely true. If somebody wants ultimate ROI, when Tom and I, our background, my brother Tom and I founded the company in '91, but our background was buying properties. Right. And at the age we were doing that, if we could buy something nothing down, we would, right? And if it went away, we were kids. We didn't care, but today, am I going to do that? Absolutely not. So we all change as we get older. We get more conservative. Back to those.
Sheila isn't going to let you do that. Sorry.
Yeah.
Little correction.
Yes. But hopefully, I'm a little smarter too. But
and the other thing to keep in mind, most of the clients who are selling their properties, the reason they might have bought some of those properties and got into real estate 20, 10, 30 years ago, whatever it is because of the benefits of depreciation. So, work with your accountant, work with your rep, understand those benefits that you might still get, or even new benefits you might get with the DST. And each DST is different. So, that's again the reason why you want to work with someone that has numerous DSTs to discuss with you. You want to find the DSTs that fit your buckets, that your check boxes that you're trying to check, not the ones that a wirehouse or maybe an RA is trying to put you in, put the peg in the square, right? Type of concept.
Steve, could we return for a moment to your comments regarding the different vertical property silos? Because how we try to stage it is we tell our investors, like it or not, real property is a capital-intensive asset. It usually costs a lot of money to buy a piece of property. So historically, it's been difficult to diversify that property portfolio functionally, geographically, and as opposed to the ease of modern portfolio theory with stocks, bonds, mutual funds, where over a long period of time you diversify, it decreases risk and it smooths out your return. And we like to say that the different property silos available in DST allow you to apply that modern portfolio theory, if you will, to real estate. Can you elaborate on that, please?
In a timely manner, right? I mean, the government has put the client on the clock. They have 45 days from the time their sale closes. And if you want to diversify and find properties in different verticals, maybe maybe let's say you have $3 million, one multifamily, one self-storage, one triple net, maybe one senior living, good luck in that 45 days trying to find a property to fit each of those buckets, where you can get that diversification with those 4 different buckets with a rep like Bob and a firm like Emerson in a couple of days. And the day you close could be a Friday. And if you've lined everything up and you have the paperwork done and you've looked at your offerings over the last couple of weeks with your rep, then you can be in those investments Monday or Tuesday earning cash flow. You're not going to get it that day, but you're accruing cash flow day one. So a lot of times we have clients that will look for properties for a couple of weeks and realize I definitely can't find 4 different diversified properties in that time frame. Right.
So I think one of the important things is with identification too. If they're getting it all closed inside the 45, they don't even have to identify anything. But with that said, so typically, if somebody comes to you, Bob, and both you guys can answer this, but as far as from the initial offering of that product to the time it's filled, what's sort of the average shelf life of something? And Bob, I know, when somebody commits with you to go buy something, how long? I mean, sort of at the extremes, can they be waiting to actually close on that thing?
Well, when we're dealing with you, Equity Advantage, because you guys are so lightning quick, once the client, most of the time is going to be taken up with the investor selecting his or her property mix. After the documents are done, and once you guys get them, that investor is likely to be closed and cash flowing within 5 business days. It happens very, very quickly, much more quickly than a conventional real estate transaction. So because of your company's efficiencies, that happens very, very quickly. Shelf life of a DST product really depends on external market conditions, size of the offering, that kind of thing. You want to speak to that, elaborate a little on?
Yeah, it varies on where we are in the cycle. I mean, and when we talk about shelf life, what we mean is that if the offering needs to raise $20 million from investors, or not needs, is raising $20 million. When that $20 million is raised, that offering is closed because there's no additional equity. Now, there might be another one very similar to it, or another different one that you may go into, but that one is closed and full. So I would say, it can vary. It can be a couple of months. It could be a year, depending on the size of the offering that the equity's out there. That's what you want to work with your rep on to understand, because you don't want to miss a window because an offering fills up.
Yeah. And just so everybody understands, Steve corrected himself just a second ago. He said needs, then he said, no, it doesn't need. Once again, the sponsor owns the asset. They're going to sell you whatever piece as you're ready to close on it. They're not waiting until everybody jumps in. So you're not dependent upon others to get it done. The sponsor owns the asset, which they're selling pieces of, and you're able to close it at the time you want to do it. Bob,
thank you. That's an important distinction.
Yeah. So years ago, I remember, and we're talking about geographic, areas for offerings, and I can't remember much here locally, but I remember there was a project out there in Hillsborough years ago that I think it came to offer, and you closed it. I mean, it's like boom. And I think back on my dad, and my dad always wanted to be able to drive by his investments, right? He said, oh, I got to tell my tennis buddies, then I own this, whatever it is. So I see that, but I mean, geographically, when people are looking for stuff, I mean, how often are they saying, Bob, I gotta have it in Oregon, right? I mean, or I mean, they're not saying in Oregon anymore, right? I mean, they're looking elsewhere. That might say, I don't want it in Oregon.
No, you well put. Everybody that I don't think we see anyone that wants to replace their property with another rental property in the Portland metro area. They're going to get that from their commercial real estate broker. So, and because commercial real estate brokers, for better or for worse, are limited, they're not specifically limited, but generally limited to local property listings, commercial property listings that they have in their pocket, that kind of thing. It's hard for them to be the Lone Ranger with an offering in Orlando, Florida, or Nashville, Tennessee. So the people we see are the people that want to get the hell out of Dodge and do it right now, any place but Oregon, any place but the West Coast, and that's exclusive. Everyone we deal with wants to take their equity to a red state if possible, because they tend to be lower tax states. They're more pro-business. And so there's the likelihood of you making more, and if you make more, you get to keep more. And that's what we deal with almost exclusively now.
And by the way, whether you're in Oregon or California, and I said the city of Portland, understand you're able to exchange out of the state, maintain total tax deferral as long as you continue to do exchanges. But don't think you're going to exchange out of California or Oregon and into Texas, for example, into a DST offering there, and it's going to hold it 5-7 years, whatever it might be. It goes full cycle. You just saved yourself the 11 to 13% you would have had to pay the states. The states are going to claw back what was deferred out of the state. So I'll say that again. The only way you're going to get away from the state taxation is if you swap till you drop.
Right.
You get stepped up basis. But other than that, understand that you're not going to exchange out, buy the asset elsewhere, and then sell it and get away from that tax consequence.
There was also, just as an aside, because I'm not an attorney, I had one abortive year in law school, and law school decided it didn't like me and I didn't like it. So we went
mutually
on
agreeable situation.
Mutually agreeable. So we went on to bigger and better things. But a very good friend of mine, Mark Hugelin, who's arguably the top estate planning attorney in the state, made a point that I was unaware of. He said there's a loophole in Oregon law where if you own real property outside of the state in a non-LLC format, and DSTs are specifically non-LLC, that property from an estate taxation plan standpoint disappears from your estate. And that's an important consideration because I believe Oregon has one of the lowest, if not the lowest, state estate tax thresholds in the United States.
Another reason to love it.
So it's a lousy place to die. And Mark made that observation to me. I was unaware of it. He said, this is something you should be talking to your DST clients about from Oregon because it's another advantage to that ownership format outside of the state because you've just reduced your taxable estate by whatever that amount was. And that was something I was totally unaware of.
So you made a comment earlier as far as what we do, right?
Mm-hmm.
And I always say you got to have a team of people. It's a complicated world these days. And I said with real estate, typically, hey, got to have a good broker, got to have finance people, property managers, title escrow. We're going to put ourselves on that team. I'm going to say you got to have a good broker dealer that's going to be vetting these assets too, and a great broker selling this stuff in the DST space. I think something that's lost is for the real estate community. We're talking about DSTs as an ultimate end game today, as a place to go at the end of the day. But I think there's a huge opportunity for people in the real estate community, whether they're investors or brokers, to be using, I say use the DST to open up opportunities for buyers, because we all drive by assets that clearly are unwanted or just sitting there rotting for some variety of reasons. And I would say a lot of times it's a seller that can't financially deal with it, or they have no idea what is possible and they don't want to pay the tax. So I think for the real estate professionals out there watching this thing, I think you need to look at it and say, hey, give people a place to go. You're going to get a listing. I think for investors, you might see a property that's a great opportunity. DST is a way, a tool to shake these people out of properties they clearly don't want or can't afford to deal with, give them a place to go, and it opens up that thing as an opportunity going forward. So I think there's other things out there, other applications as process. I think that's where you made a comment earlier about the commercial brokerage community has been sort of adverse to this stuff. But I think really they need to be looking at it from a situation. It's like, look, this is giving people a place to go, opens up opportunity, and that's what this thing is. So, and as you've said, Steve, I mean, there's always product out there that's going to fit people's needs. Now, I think one of the other differentiations between institutional TIC and the DST that comes up is what percentage of the DST offerings that Emerson puts on the platform are multi-asset versus single asset?
Oh, that's we're seeing more multi-asset properties. So you do see it, whether it be in self-storage or even multifamily or triple net lease. So we do see it. What's the percentage? I would say probably 40% are multi, or 30% would be multi-asset.
So even in a... Excuse me. That's all right. Even in a single offering. So we've talked about diversification geographically and vertically, but we also have the potential for diversification in a single offering.
Geographically, yeah.
Geographically, when DST started out 25 years ago, it was always one DST, one property. And as the product has evolved or matured, oftentimes they now resemble small REITs, albeit to a specific property type with multiple properties, as Steve just said, multifamily, self-storage, industrial warehousing, in one DST. So again, that, I think, puts paid to the notion that 721 UPREITs are great because it's the only way you can diversify. No, increasingly you can diversify multiple ways with individual DSTs and not surrender your ability to continue to 1031 exchange forward and defer capital gains liability. Like you said, mantra in our industry is swap till you drop, because the longer you defer that gain, the likelihood is the bigger it gets and the bigger the bite's going to be if and when you opt out.
So couple comments. I mean, deal with a sponsor that understands this stuff and been through it. If you're dealing with some new sponsor, they put a single offering together. Let's say it's got 10 properties in 10 states. You got 10 tax returns. So typically the ones that are doing this that have done it for a while are going to package things in a finite area to minimize that.
And those type of offerings are a little more limited.
Yeah.
I would say there's not more than 5% of the offerings are like that. When I think multi-properties in a DST, I'm thinking 2 or 3.
Yeah.
There are some where there are 10, but there's not tons of those.
So think about this, and this is another issue to contemplate in a 1031 exchange. And this has to do with timelines. It's like, okay, so what is that? And by the way, you've commented some about taxation and, hey, you got to talk to your tax people, right? None of us are supposed to be giving tax or legal advice in these situations. The problem I have is I'm doing this stuff day in, day out, so the tax and legal community comes to me and asks questions, right? And I actually do CE for those communities too. But if we look at these things, if somebody IDs a single DST offering that's, let's say it's 10 properties, there are companies in my industry that will treat that as 10 ID'd properties. Okay, that's not our policy. Our policy is it's one. And the reason it's one is you don't have the ability, the taxpayer does not have the ability to bifurcate that transaction. They cannot take and select pieces of it. It's one or none of it. It's the whole thing. So I think it's important, from the context of working in this space, if you get it all done inside the 45 days, none of it even matters.
Right.
If you're outside the 45 days, you better understand what your accommodation company is going to accept for those identifications, and it could torpedo a deal. And I think, Bob, we've talked about a couple transactions through the years that were destroyed because of an accommodation company saying, no, you didn't fit the ID rules, and now you got a problem with that.
We had a near-death experience with that a while back with IPX being a big corporation. They take all the necessary holidays, and it just so happened that our DST client's 45-day window ended on Martin Luther King Day. And so, like all good retail investors, he procrastinated and waited to the 45th day to do his property ID. Calls IPX, they're closed. It's national holiday. Calls us. I said, dude, this is not my job. That's their job. That being said, it is my understanding that if you cannot buy that property separately or severally from the other property, it counts as one ID, because he was going into a DST that had, I think, 5 different multifamily properties in it. And so he used the 3-property rule, okay? He calls me back with his panties all in a bunch the next day. IPX just told me my exchange is invalid because I should have used the 200% rule because I got more than 3 properties, yada, yada, yada. I said, that's not right. I got on the phone, blew up the phone with the then head of IPX, no, this is our company policy. And so I went out. Fortunately, my CPA was best friends with the retiring deputy director of the IRS. So he got
good friend.
He got a letter specifically from this gentleman stating that it is IRS policy that unless that property can be purchased separate from the other, it counts as one property identification. I shoved that in front of IPX's face and forced them to take to validate the exchange, but they said they weren't going to change company policy because of that. So yeah, that's how responsive some of the bigger, much more bureaucratized exchange entities are. They can't or won't get out of their little box.
Yeah, I just want to make the point. You got to understand, ask the questions. You don't ask the question, and back to AI, right? It doesn't know what to ask. No. And it's sort of interesting. So we had a couple of years ago, actually probably a year ago, one of my closers in here came to me. And he was all excited because he was dealing with this DST sponsor had reached out, and this guy had sold his company to, I don't know, Grubhub or somebody like that. So, and he was doing TED Talks. Right. And I'm thinking, well, yeah, that's great, Randy. So what's his real estate background? Well, there wasn't. It was a brand new DST company, and they were paying some pretty high numbers. I said, Randy, let's take a look. One, let's see how long they've been in business. So he said, well, how do you do that? So I said, okay, what state are they? Where are they? And let's take a look at the Department of Corporations there. Saw when they were registered. It was very recent. And I said, so what do you think? What do you think the most important issues are for a sponsor? I mean, if they're putting these things together, what are we looking at? How are they going to, what are they doing to packages, saying what's their background? It's going to be acquisition, what they're doing with the thing, and then the management of it, right?
Right.
So you want the history, so that people are going through those things. Well, they didn't have the history. The acquisition was being done by somebody that had been a residential broker until recently, and then the management was, it appered to be, one of the founders' friends from college.
Yeah.
I said, so what do you think the likelihood of this thing actually working is going to be? But on the board of directors was another celebrity, but it was like a celebrity name. I said, well, yeah, it's probably the guy's kid, but it was, a very famous person. So they were saying, hey, this is, I do TED Talks, I do this, and I got these people involved. This guy's on my board, but you don't know what you don't know.
No, and I think you do want to go, real estate experience is probably one of the top 2 or top 3, if not the top requirement when picking a sponsor. Maybe they haven't done a DST before, but if they've bought and sold for family offices, wealthy individuals, institutional investors, properties over the last 10, 20, 30 years, they're experts in buying and selling real estate,
yes.
Right? And then the next question, management. Who's going to manage this property? Is it a management in heavy type of property or a management light type of property? And if it's a management heavy type of property, let's say like self-storage or senior living, you want a company that is not only the sponsor on the DST, but also has a management company, whether an affiliated company or part of the sponsor, because that experience is going to be paramount to the success of the DST. And I will liken that example that you just talked about to, was it 4 or 5 years ago when everybody was forming a SPAC? And, we're going to merge this SPAC with that and that. It's like when something's hot, everybody wants to be a sponsor, right? But it's our job to figure out, what's the experience of this first-time sponsor. Obviously, if they're not a first-time sponsor, they've done multiple offerings, it's much easier to see. But, if they're a first-time sponsor or even a second or third-time sponsor and they have years of real estate investment, isn't that who you want to invest with?
That's exactly right, because there are right now on the Emerson platform, there are several newly come sponsors to the DST space, but they have a long and very successful track record in private equity, which precedes DST in terms of raising money, buying properties, stabilizing them, increasing the NOI, and then selling them at a profit for investors. So that's no guarantee, but it's a pretty strong indication that these people know what the hell they're doing with regard to this property type, and that may very well translate into good news for DST investors.
So if you look at the history of your firm, and we talk about it all the time. You see, you look at around 2000, right, and then you go forward to the crash, and there were how many sponsors? Roughly 70 pre-crash.
50. Went down real fast.
Yeah, and then it dropped to a half dozen. Mm-hmm. And where are we today? I think the last numbers I saw is mid-50s, high 50s.
Maybe up to 60s now.
60-something now.
There's some few new sponsors that have come in the last, I'll say even the last year, but the last 2 or 3 years.
But you have 50 to 55 that have never seen a bad day. So once again, to your point, if that firm hasn't seen it, who are the principals, what's their background? That's what you guys are both saying.
And they might not have seen a
bad
day in the DST space, right?
Yes.
Because it's really only been around for 12 years, maybe a little bit more. But they've probably seen bad days in real estate.
Yeah.
Whether it be 2009 or 8, or even, in the teens, the 2000 teens, there were some periods. So that is very important. And I do think it's also important that the sponsor is focused on likely one vertical. Like, they don't do self-storage and then next week do multifamily. They do self-storage.
That's a really good
Yeah.
point. The difference, you want to elaborate on the difference between generalists in the DST space and specialists, please?
Yeah, and it's not that there are some great DST sponsors out there that have been around for a long time, but that might do offerings in different verticals, throughout the year, right? My view is that the self-storage sponsors should be experts in self-storage operation and management. And they likely own or manage 100 or so other properties that they've built up over the last 10 years, let's say. And I do think that's very important to look at. And I do think that is often what separates, the offerings that are out there that are on our platform, maybe from the offerings that are on other people's platform.
So whatever you're doing, be the best at it.
Yeah, be the best at it. And not only whether you're a sponsor or a broker dealer or a rep, be the best, or a QI, be the best at it.
Yeah, I mean, and we oftentimes get this because everybody shops. And it's like, well, what's the difference between I'm talking to this guy? What's the difference between talking to this guy or gal and you? Well, it's our platform, okay? Anyone can have the big companies, the generalists that do everything because of the size of the Emerson platform and the fact that we do close to 10% of total DST transactions year in, year out. We have many specialized DST sponsors, as Steve said, in the storage space, in senior living. And increasingly, that's what we encourage people to go to, because if they're a specialist, they probably have a lot of boots on the ground from a management and acquisition standpoint. So they're probably better able to turn over enough rocks to find a good deal where you may not be competing with a lot of institutional money. So we usually from those specialists get better acquisition cap rates, correspondingly better cash flows, and hopefully more appreciation potential. So I think that's a real point of distinction with regard to Emerson Equity.
Well, and the sponsors a lot of times that have this experience, especially in these specific verticals, they're not going, and if it's triple net lease, they're not looking for a triple net lease property that's open to everyone, and is a general property that they're buying and then putting in a DST.
Yeah.
It's normally a negotiated transaction that you as an individual investor would never have the option to look at. Okay. Because it's very off market, and that's the type of product and properties they're putting in DSTs.
Great. Okay, I think we'll take a quick break. Let's take a couple minutes and we'll be right back.